Okay, so let's dive into the story of a company that has investors, well, completely divided. On one side, you have this incredible story of explosive growth, and on the other, a pretty serious tale of deep-seated risks. This is the story of Transformers and Rectifiers India.
First, just take a look at this number. In the last 5 years, the stock price for Transformers and Rectifiers India, we'll call it Taril, just skyrocketed by over 3,000%. I mean, what an absolutely incredible run for any investor who got in early.
But then, this happens. In just the last 6 months, the stock has plummeted by 45%, wiped out a huge chunk of that value. And this kind of whiplash is exactly what gets investors talking.
So this whole wild ride, it really boils down to one crucial question for any of us as investors. What is really going on here? Is this just a temporary dip in a much longer growth story, making it an amazing opportunity? Or is this a dangerous trap, signaling much deeper problems? All right, to get to the bottom of this, we've got to look at the company through two totally different lenses. So let's start with the first one, the bull case. This is the view that sees a wonderful company at a fair price.
The argument here is that Taril is just perfectly positioned to ride this massive wave of India's energy transition. We're talking about huge government initiatives to modernize the entire power grid, which is creating this historic, almost once-in-a-generation level of demand for what they make.
And you can see the results of that supercycle right here. Just look at the numbers for fiscal year 2025. Revenue, it soared over 56%. And get this, net profit absolutely exploded by 360%. I mean, that's not just growth, right? That's a whole different ballgame.
You can see that incredible jump in profitability right on this chart. So what's behind it? Well, the key driver was a massive expansion in their operating margins. They jumped from under 10% to over 16%. That tells you they're not just selling more, they're selling more complex, higher value stuff.
So what protects all this growth? Well, the bulls point to what investors call an economic moat. Basically, a strong, durable competitive advantage. And believe me, in a complex industry like this one, having a moat is everything.
And Taril's moat, it's built on some seriously specialized technical expertise. They are one of the few companies in the entire world capable of making 1,200 kilovolt transformers. We're talking the absolute pinnacle of grid technology. This is not something a new competitor can just decide to start doing tomorrow. It takes decades of deep engineering know-how.
And here is the real kicker for the bull case, the valuation. Despite its technical leadership and that explosive growth we just saw, Taril trades at a price-to-earnings ratio of about 30. Its peers, like Hitachi and CG Power, are trading at multiples well over 90, even 130. From this angle, Taril looks like it's on sale at a massive discount. Okay, that's a pretty compelling story, right? But now we have to flip the coin. Let's put on our second lens and see how you can build a completely different narrative. This is the bear case, and it warns that this recent recovery might be hiding much deeper risks. And this quote, man, it just perfectly captures the entire bear argument. Critics, like the analyst Dr. Vijay Malik, they argue that investors are getting swept up in this current industry boom and mistaking it for a permanent structural change in the company itself.
And this is where that argument really hits home. When you zoom way out and look at the company's entire 23-year history, you see this classic boom and bust cycle. The company hits a peak profit margin of around 11%, then it crashes into losses or barely breaks even for years before hitting that same 11% peak again. So what's the long-term average profit margin? A much less exciting 4%.
So what this long history tells us is that when the cycle inevitably turns down, this business really struggles. It's in a tough spot with intense competition, it's had to dilute shareholder value just to fund its expansions, and it's got a history of cash flow problems, even needing loans from its own founders to stay afloat in the tough times.
Here's another point of concern for the bears. Over 21% of the promoters' shares, that is, the shares held by the company's founders, are pledged, which means they're being used as collateral for loans. And you can see why that's a risk, right? If the stock price falls, those lenders could be forced to sell the shares, putting even more pressure on the price.
This brings us to what might just be the most critical part of the bear case, the so-called yellow flags around corporate governance. And folks, this is where the story gets really complicated.
I mean, think about this. Over just a few turbulent months, the company gets hit with a debarment notice from the World Bank and then sees a wave of top-level resignations, an independent director, the CEO, and the CFO. That is a ton of turmoil right at the very top.
And we need to be clear,
This World Bank thing, it wasn't some minor slap on the wrist. We're talking about serious allegations of fraudulent and corrupt practices tied to a project in Nigeria. Now, the company contests this, but it still creates this huge cloud of reputational risk.
And that revolving door at the top? It seems to be a real pattern. The company has had 2 consecutive external CEOs resign within just a few months of taking the job. That kind of rapid turnover raises some pretty serious questions about leadership stability and the internal culture of the company.
So, what do you do with this? You've got 2 completely opposite stories. A high-growth tech leader on one side and a risky, cyclical business with governance issues on the other. How do you make sense of it all? Well, this is where we need to step back and build our own investor toolkit.
The most important thing to get is that the bull and the bear, they're looking at the exact same company. They're just using different tools. The bull is using a telescope, focusing way out on the distant horizon of future growth. But the bear is using a microscope, examining all the present flaws and past scars up close.
So here's a toolkit you can use for any company, not just this one, to get a more balanced picture. First, you've got to zoom out and see the full history. Second, read the fine print on governance. Third, really understand the business cycle. And finally, always follow the cash. And you know, this really gets to the heart of what good analysis is all about. The goal isn't to pick a winner or declare the bulls or the bears right. It's about understanding all the evidence so well that you could actually argue both sides of the case convincingly.
So this whole story of Taril, it's just a fantastic real-world lesson. It leaves us with one last question to ask ourselves, not just about this company, but about any investment we look at. Which lens are you using? Are you looking through the telescope, the microscope, or are you making sure to use both?